Good evening, financial gladiators, and welcome back to Boss Economics World, the only show that treats the global economy not as a science, but as the high-stakes, often ridiculous, reality TV show it truly is. Tonight, we journey to the land of pristine mountains, clandestine bank accounts, and politically neutral chocolate, Switzerland. On September 26, 2025, from their marble fortress in Zurich, the Swiss National Bank delivered a masterclass in what I like to call proactive paralysis. They held their benchmark interest rate at a perfectly, beautifully, uninspiringly flat zero. Now, on the surface, this is the economic equivalent of watching paint dry. But underneath this placid alpine lake, my friends, a geopolitical kraken is stirring. And its name is Donald J. Trump, whose administration has just slapped a colossal 39% tariff on a range of Swiss goods. SNB President Martin Schlegel, a man whose public speaking style makes Valium look like a triple espresso, stepped up to the podium and delivered a line so perfectly bureaucratic, so exquisitely detached from reality, it deserves to be framed in the Museum of Modern Spin. He acknowledged the tariffs would be very challenging for some firms, but insisted the overall impact on the economy is, wait for it, limited. 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 The most versatile word in the central banker's lexicon. It's the linguistic equivalent of putting a single, tiny band-aid on a gaping arterial wound. According to the SNB's calculus, because only 4% of Swiss exports are directly hit, the rest of the country can just go about their business, happily yodeling and enjoying their fondue. This, ladies and gentlemen, is like saying a shark bite is a limited problem because it only affects the leg that's been bitten off. It's a spectacular failure to understand the interconnected, gossamer thin threads of the modern economy. Tonight, we're going to pull on those threads and watch the whole pristine Swiss sweater unravel. We're going from the point that 4% to the surface, the terrifying new reality for every small, open economy on this fractured planet. Let's dissect this 4% is limited argument, because it's the cornerstone of the SNB's entire, rickety edifice of inaction. Who is in this 4%? It's not just a rounding error on a spreadsheet. It's the lifeblood of Switzerland's high-value manufacturing sector. We're talking about precision machinery, pharmaceuticals, and of course, luxury watches. Imagine you're the CEO of Helvetia Horology, a fictional but entirely plausible watchmaker in the Jura Mountains. For generations, your family has been crafting exquisite timepieces. Your biggest market? The affluent American consumer. Overnight, your $10,000 watch now costs an American buyer $13,900. Your sales don't just dip, they fall off a cliff. You're now competing with Italian and French rivals who don't face this punitive levy. So what do? You cancel expansion plans. You freeze hiring. You tell your suppliers, the local artisan who makes the leather straps, the precision engineering firm that cuts the sapphire crystals, the marketing agency in Geneva, that orders are being slashed. Suddenly, that limited 4% problem has metastasized. It's now infecting a dozen other businesses that were, on paper, unaffected by the tariffs. The latest Swiss PMI data, released just this week, tells the real story. The manufacturing export subindex just cratered to 45.2, a sharp contraction and a level not seen since the peak of the 2020 pandemic lockdowns. That's not a limited impact, that's a 5-alarm fire in the engine room. The KOF Economic Institute, Switzerland's own leading research body, isn't buying the SNB's cool as a cucumber act either. They've just slashed their 2026 growth forecast from a modest 1.8% to a borderline recessionary 0.5%. They are explicitly citing the crippling second-order effects of the US tariffs. So, while the SNB is calmly asserting that the house is structurally sound, the professional fire inspectors are screaming that the foundations are crumbling. But the tariff isn't even the main villain in this drama. The tariff is just the catalyst. The true monster, the one lurking in the shadows for years, is the Swiss franc itself. In times of global uncertainty and a second Trump presidency imposing random 39% tariffs is the very definition of uncertainty, capital doesn't walk, it flees. And it flees to so-called safe havens. Gold, US Treasuries, and the undisputed heavyweight champion of currency havens, the Swiss franc. Look at this chart. The franc has appreciated a staggering 12% against the US dollar this year alone, hitting a decade high last week. It's also up nearly 1% against the euro, its most important trading partner. This is the paradox of safety. The more chaotic the world becomes, the more money floods into Switzerland. This flood of demand makes the franc stronger. And a stronger franc acts as a stealth tariff on every single Swiss export. So, our beleaguered watchmaker at Helvetia Horology isn't just dealing with Trump's 39% tariff. His watches are also 12% more expensive for American buyers simply due to the currency's rise. It's a brutal 1-2 punch that is knocking out Swiss industry. That limited 4% is now a 100% problem. Every Swiss company trying to sell anything abroad is fighting with one hand tied behind its back. What did President Schlegel have to say about this? When asked if the franc was overvalued, he elegantly declined to comment, stating that giving a reassessment of the strength of the Swiss franc every quarter is no longer helpful. The currency is at a level that is actively strangling our export economy, but if we admit it, we'll trigger a panic, so we've decided the most prudent course of action is to stare at the ceiling and pretend it isn't happening. This isn't monetary policy, it's a strategic ostrich maneuver. This currency strength also imports deflation. A strong franc makes everything the Swiss buy from abroad, German cars, French wine, Chinese electronics, cheaper. This pushes down consumer prices. The SNB's own inflation forecast is a tragic joke, 0.2% this year, rising to a pathetic 0.7% in 2027. Their target is 0 to 2%. They are permanently scraping the floor of their own mandate, and their primary policy response is to wait and see. So why? Why are these incredibly smart people in Zurich choosing to do nothing while their economy is being squeezed in a vice? Because they are trapped in the modern central banker's Kobayashi Maru, a no-win scenario. Every single tool at their disposal comes with a potentially catastrophic side effect. Option A, cut interest rates. Almost everyone expected them to cut. A quarter of economists surveyed by Bloomberg still think they'll be forced to cut by December. The logical response to a slowing economy, deflationary pressure, and a soaring currency is to make your own currency less attractive by cutting rates. But where can they cut to? Zero. The next step is the haunted house of modern monetary policy, negative interest rate policy. The SNB knows this territory well, they only escaped it 3 years ago. Negative rates are a desperate, world-warping measure. They punish savers. They eviscerate the business models of banks and insurance companies, who are forced to pay the central bank to hold their cash. They create perverse incentives and fuel dangerous asset bubbles in housing and stocks as desperate investors hunt for any sliver of yield. Schlegel himself admitted the bar to go into negative territory is certainly higher. This is the ultimate admission of failure. They know the medicine is a poison, and they're terrified to administer it unless the patient is already clinically dead. They would rather sacrifice their industrial sector on the altar of a strong franc than risk destabilizing their colossal, globally systemic banking sector with another dose of NIRP. Option B, intervene in currency markets. The SNB could print billions of francs and use them to buy euros and dollars, artificially weakening their currency. They've done this before. In fact, they did it on such a gargantuan scale in the 2010s that their balance sheet swelled to over 100% of Swiss GDP, a level that makes the US Federal Reserve look like a cautious amateur. The problem is, they are still sitting on this mountain of foreign currency. Selling francs now would just make the mountain bigger. It opens them up to accusations of currency manipulation from, you guessed it, the Trump administration. It also exposes Swiss taxpayers to monumental losses if those foreign currencies fall in value. They are politically and financially cornered. Option C, do nothing. This is the path they chose. It's the wait-and-see approach. They are hoping the tariffs are a temporary political storm. They are hoping the global flight to safety abates. They are, in essence, sacrificing their exporters today in the desperate hope that tomorrow might be better. But hope is not a strategy. By holding rates at zero while the US Fed has already started cutting in response to the tariff-induced slowdown, the SNB is making the franc even more attractive relative to the dollar. Their inaction is actively worsening the currency crisis. They are standing still while the ground crumbles beneath them. So, what does this all mean for you, whether you're a hedge fund manager in New York or a concerned citizen watching your pension plan? It means that Switzerland is the canary in the global coal mine. It is the perfect, distilled example of the existential crisis facing every small, open, trade-dependent economy in the new age of deglobalization and populist protectionism. The post-Cold War consensus is dead. The era where you could be a small, neutral country that just focused on making high-quality goods for a frictionless global market is over. Your economic fate is now subject to the whims of a 3 a.m. tweet from Mar-a-Lago or a strategic rivalry between Washington and Beijing. The SNB's decision wasn't about economics in a vacuum. It was a political calculation masquerading as monetary policy. They've judged that the slow, grinding pain of an overvalued currency and a crippled export sector is preferable to the acute, systemic risks of negative rates or the geopolitical risks of massive currency intervention. The great irony is that for decades, the world's wealthy have used Switzerland as their shelter from the storms of their own countries. Now, the storm has come to the shelter itself. The gnomes of Zurich, those legendary masters of finance, have run out of tricks. They are trapped by their own success, paralyzed by their own safe haven status. The question is no longer whether the SNB will cut rates in December. The real question is whether the entire Swiss economic model, built on political neutrality, a strong currency, and open borders, can even survive in this new world disorder. So, grab your popcorn and keep your eye on the Alps. The pristine, orderly world of Swiss finance is about to get very, very messy. And you can be sure we'll be here to cover every glorious, chaotic moment. This is Boss Economics World. Don't just watch the money. Understand the game.